Okay, so here we have a good question from Mr. Damien. We're going to be speaking about futures and the funding rates and what they mean. So futures contracts are essentially, and this is very beginner right here, futures contracts are essentially a contract that you can trade that will expire at a future date. So usually your expiration dates are going to be coming at like the end of the month or the end of the quarter. Something like that is quite normal. Now, you also have what's typically called a perpetual futures contract on a lot of these exchanges, like Phemex, which is what we're on right here. And that is essentially a non-expiring contract that it's technically a futures contract, but it doesn't expire ever. So it's not really a futures contract, to be fair. It's basically a crypto bastardized way of allowing you to take a spot position on leverage against, on a futures exchange. So you can also trade the futures against it, essentially. Anyways, I think that is simple enough right there. Now let's explain the funding rate. So with the perpetual contracts, not with any of the other actual futures contracts, which actually do have an expiration date, you have what's called a funding rate to represent essentially, essentially it represents like the current demand at that level, and what it is going to do for you and what it's going to tell you, and what it actually functions as is a balancing effect between the index price for that exchange and then the mark price on your perp contracts or perpetual contracts. So because there's no expiration date for these perpetual contracts, there needs to be something on the other end to kind of balance it out. And that's how they've figured out this for most of these cryptocurrency exchanges. Anyways, the funding rate can be found right here. And what it essentially is, or you actually can't see it that well right there, but it's right here. It tells you on the exchange. It should always tell you the funding rate for the current period, which changes every 8 hours typically. And the funding rate currently is 0.0477% per contract. So what does that mean? That means that if you are holding a long right now on the Phemex exchange, you will pay, if you're holding that long, 0.0477% per contract that you have long into the expiration. With that in mind, it should also be known that if you are short and holding that contract into the funding period, which you can kind of look at as an expiration, you actually get paid that. So you will literally be paid to hold short right now. Rather good amount, actually. Now, I want to address a nuance here as well. So while the funding rate is relevant if you're holding at the point of that expiration for that funding rate period, again, every 8 hours, then what do you expect? How can you kind of circumvent that? You can circumvent that by actually dropping your position 1 second before the actual funding rate expiration or the funding rate period ending. So if the funding rate were to end right now, and I close my position 1 second before, I will not pay if I was long that funding rate. By contrast, if I was short, I would not get paid that funding rate as well. Then you also have what's right here, right below it, which is called the predicted rate. The predicted rate is what they believe, based off of current price action and all the underlying information, will be the funding rate for the next period following this current one. So that's rather self-explanatory. And actually, you can see the time to expiration right here on the funding rate. It's 16 minutes and 53 seconds. So if I were to literally hold a long position 1 second before that and then dump it, I would not pay this rate. And you can see the next predicted rate, the time down to that one as well. Anyways, I hope that that's clear. If there's any more nuances to this sort of thing, let me know on this video, and I can address that. But basically, the way that you can understand perpetual contracts is that they are something that is allows you to have leverage that does not have an expiration and trades very close to the spot price action through a mechanism that essentially has the funding rate related to the mark price and then, of course, the index price. The index price changes amongst different exchanges, but basically it's an average typically of 2 or more spot exchanges that is then marked off the mark price on that exchange, and then the differential between the mark price and the index price is what creates your funding rate. So that's how it works. Do you need to understand that to trade them? Not necessarily. What you really need to know is your funding rate. You need to know when it expires. You need to know whether you're paying or getting paid, and if that means anything for you. Okay, cool. I think that covers that, and well, there you go.